Well, the banking sector in the midst of its first earnings season following regional bank collapses. But could fears over financial system stability and credit availability actually work in the Fed's favor? Here with more, Ben Laidler, eToro Global Market Strategist. Good to have you on, Ben. So break this down for us, because this could effectively be seen as another form of tightening that lets the Fed sit back a little bit here.
I think that's exactly right. I think financial conditions are tightening. I think the banks are going to be doing the Fed's work for it. We're not saying there's a banking crisis, but we have lived through a scare, and I think that means a couple of things. I think deposits are leaving the system; they're being attracted into money market funds by the 5% rates that are on offer versus the sub 1% you get at your bank. That predates SVB. And the recent banking scare. So I think that's going to continue, and you've absolutely seen that even with the results from the big banks. Secondly, I think there's going to be a regulatory crackdown. I think that's absolutely inevitable. And I think thirdly, the smaller banks have seen the worst of these sort of deposit outflows, are going to see the worst of this regulatory crackdown. But I think regardless, everybody is going to be lending less going forward than they might otherwise have done. And lending standards were already tightening. So again, I think this is just, we've already got the lagged effect of 5% interest rates. And now on top of that, we've got banks which are going to be lending less. And that combination is going to slow the economy and slow earnings, which we really haven't seen yet.
So then is it too soon to say that the banking crisis is over?
I don't think we've had a banking crisis. I think we've had a banking scare. I think this is an issue for individual banks rather than the system, but there are real macroeconomic consequences, as I say. I think the system as a whole will be lending less than it would otherwise have done. That's going to feed through into the real economy. That's going to particularly hurt, some segments, commercial real estate, small caps, but it is going to have a broader macro impact. And I think the way to think about it is this is the replacement for an extra 50, 75 basis points of Fed hikes, which we now won't see.
And we mentioned some of that hangover from, as you call it, a banking scare, the IMF looking at it as a banking crisis. But really, as you look at tighter lending conditions, really feeding into this slower global growth story as well, are there some signs that we should be watching for? You mentioned small caps there, how it's going to play out for them.
Yeah, absolutely. The stock market's not the economy. There are some segments of the market which are the sort of canary in the coal mine, which are, particularly sensitive to this tightening of lending standards, to the slowing of the economy. Commodities, I don't think it's any surprise that that's the worst performing asset class this year, particularly sensitive to the slowdown in growth. Small caps, they're still up for the year, but they've absolutely lagged. Again, that's no surprise, very domestic, carry a bit more debt, less diversified. Industrials, these are the bits that I think are particularly sensitive to this slowdown. And on the flip side, there are things like tech, things like healthcare, which are pretty defensive, are very big in the stock market, but somewhat less big in the overall economy.
So then when you add up some of this tightening that we're going to see, the banking scare, how are you seeing that, or how are you expecting to show up in some of this earnings commentary as we get into the thick of earnings season?
So I think this is going to be another less bad earnings season. I think the reported numbers are going to look pretty good, and we're all going to breathe a sort of sigh of relief. GDP growth in the first quarter was something like 2.5%. It was pretty good. Expectations were cut a lot into earnings season, and 40% of US earnings come from the rest of the world, which has seen a particularly good sort of rebound here at very low levels. So I think the reported numbers are going to look very good. My fear is what comes next. And I think the guidance is going to be a little bit more downbeat. In some ways, I actually think this reporting season is going to be a little bit of a head fake. I think the best results are going to come from the small caps, the cyclicals, the consumer discretionary names, the ones that are maybe going to suffer the most in the economic slowdown, which I think is inevitably coming.
And so then a lot of people obviously wondering what the Fed is going to do. Markets seem to be bracing for, a very quick pause. You're expecting one final, what you call an insurance hike from the Fed on May 3rd. Fed Governor Waller, though, signaling he wants the Fed to go further to bring down inflation. How do you position yourself, and why do you expect just that one more hike in May?
Right. I think we've broken the back of inflation. We've core PCE, under 5%. We producer prices, under 3%. A lot of the coincident or leading indicators, Zillow rents or services prices paid PMIs, they're all significantly lower than what you're seeing in the reported sort of CPI numbers. So, yes, the Fed may want to take one more insurance hike, but I think the combination of this sort of lagged impact of 5% rates plus what we're now seeing of these tightening lending conditions in the banking system, I think that will accelerate the fall in earnings and GDP. That may sound like bad news, but I don't think it is for stock markets because they're forward looking. I think they're going to look at that inflation fall. They're going to look at the fact that interest rates can be cut earlier. And I think it takes markets up, led by those longer duration sectors, which are most sensitive to lower inflation and lower interest rates. So big tech, defensive healthcare names, and other asset classes, which are long duration, like bonds and like crypto. I think that will be the leadership. I think it'll be the more cyclical, more economically sensitive bits of the market, which we just touched on. I mean, the commodities and small caps, which will lag here.
Certainly a lot to keep an eye on there. We do appreciate you joining us this morning. Ben Laidler, eToro Global Market Strategist, thank you for your time this morning.